what to do next year. KPMG chief economist Diane Swonk joins us. Diane, how do you read the spillover effects from what happened in banking this past month for the economy?
Well, it's very important because, first of all, the financial fragilities that were revealed were global in scope. Second of all, we know that the bulk of the credit tightening not only related to the events of the last several weeks, but related to the lags on monetary policy tightening are still ahead of us. And at this point in time, to think that you can calibrate it even by just moving a quarter point at each meeting by the Federal Reserve, which is what we've heard in unison, even from those who are most dovish on the Federal Open Market Committee. Yesterday, Susan Collins, I was there, and she said, there's more work to be done. We heard it from Tom Barkin as well. All of this echoed of we're still going to raise rates at a time when I don't think they need to cut rates yet, but we don't have a lot of view on the finish line. And I said, inflation is like a marathon, not a sprint. We haven't yet hit the hardest mile, and we now can't get a real focus on the finish line. In order to get over the finish line without causing a much deeper and more scarring recession, I think the Fed needs to take a breath and get a focus and get some view on what the terrain ahead is going to look like. I think there's a lot of potholes in the rest of this marathon that they don't want to get tripped up in that could cause a much deeper recession and much more cooling of the economy. A chilling to a freezing point is not what you want to have at this stage. You want to cool the economy.
Right.
And I think
so
that's
Diane,
a very difficult high wire act.
Yeah. No, I was just going to say, I think the market's with you. I think the market, that's what the market is telling us, right? That it's time for a pause and then for cuts and don't make a mistake here. But that's not what the Fed is telling us. So do you ultimately think there is going to be a mistake made?
I do think the risk of a mistake just went up quite dramatically. And I do think it's important, too, that the markets are a little bit, the Goldilocks scenario is not really out there. This is not a mild situation. There is, nonlinearity is the word we're hearing from central bankers over and over and over again. And that is that, the effects of this compound. And once you get a rise in unemployment, it doesn't necessarily go up by only a little bit. There is no garden variety recession out there. It can get out of control very rapidly. And that doesn't mean the Fed is going to be cutting to zero unless we have a full credit market seizure, which, of course, they want to avoid as well. And I think the financial markets have gotten a little bit too much into the idea that somehow there's no pain with this. It's not a Goldilocks scenario. I think the risk of a misstep is much higher, which will also hit profits as well. And it's not just the Fed going back to zero interest rates unless they really mess up the financial stability situation. And I don't think that's where they're at either. But I think the bottom line is that we're talking about a scenario where the Fed is still hedging against averting the mistakes of the 1970s, not snuffing out inflation soon enough and being harder on inflation. When a second risk has come up, and that is that the credit tightening already in the pipeline is going to add to cooling inflation in a much more disorderly way. And that's not what their goal is.